Don't you dare think for a single second that just because you stop punching a time clock, the Internal Revenue Service stops looking at your wallet. Look at me. Listen to me. The biggest shock, the single greatest fear that trips up almost every single person about to retire is the devastating misconception that retirement income is tax-free. It is not. If you do not understand the rules of the game before you step off the field, you are going to get absolutely clobbered by Uncle Sam. You see, when you were working, it was easy. You had a W-2. Your employer took out the taxes before the money ever hit your bank account. You lived on what was left. But the moment you retire, you become your own payroll department. Suddenly, you have multiple streams of income pouring in from different buckets, and every single one of those buckets is treated differently by the tax code. If you do not coordinate them correctly, you can accidentally push yourself into a higher tax bracket, trigger massive penalties on your Medicare premiums, and watch a massive chunk of your hard-earned life savings simply vanish. So let's break down the ultimate question: how much tax do you actually pay when you retire? The answer depends entirely on where your money is coming from. Let's start with your Social Security benefits, because this is where the confusion turns into real financial pain. Millions of retirees believe that because they paid Social Security taxes their entire working lives, their monthly benefit checks will be completely tax-free. I am telling you right now, for many of you, that is a dangerous illusion. The IRS uses a very specific calculation called your provisional income to determine if your Social Security is taxable. To find your provisional income, you take your adjusted gross income, you add any tax-exempt interest you earned, and then you add exactly half of your Social Security benefits. If you are filing as an individual and that total is between $25,000 and $34,000, up to 50% of your Social Security benefits become subject to ordinary income tax. If that total goes over $34,000, up to 85% of your benefits can be taxed. For married couples filing jointly, those thresholds are $32,000 and $44,000. Think about how low those numbers are. If you have a decent pension or if you are pulling money out of a traditional retirement account to pay your bills, you are going to blow right past those limits, and suddenly, up to 85% of your government check is fair game for the taxman. Now let's talk about your next big bucket, your traditional 401k plans and traditional IRAs. Every single dollar you put into those accounts during your working years gave you a nice tax break back then. You felt great about it. But remember this, that money was not a gift. It was a tax deferral. Every penny you pull out of a traditional retirement account in retirement is taxed at your ordinary income tax rate, just like regular wages from an old job. And it gets worse. You cannot just leave that money in there forever to grow. The government wants its cut. When you reach a certain age, you are legally forced to take required minimum distributions. You have no choice. The IRS calculates a specific amount you must withdraw every year based on your life expectancy, and they slap you with ordinary income tax on it. If you refuse or forget to take it, the penalty used to be an astronomical 50%, and even though it has been lowered to 25% or 10% if corrected quickly, it is still a massive financial blow. These mandatory distributions can act like a runaway train, artificially boosting your income, triggering the tax on your Social Security, and pushing your standard Medicare premiums through the roof due to income-related adjustments. But it is not all bad news, because you have complete control over how you handle your other buckets. If you have a Roth IRA or a Roth 401k, that money is your absolute best friend in retirement. You already paid the taxes on that money before you put it in. That means when you take withdrawals from a Roth account in retirement, that money is 100% tax-free to you. It does not count toward your tax brackets, it does not factor into the calculation that makes your Social Security taxable, and it completely bypasses the mandatory distribution rules. Then you have your standard taxable brokerage accounts, your regular stocks, bonds, and mutual funds. If you hold these investments for more than 1 year before selling them to fund your retirement lifestyle, you get a beautiful tax break called the long-term capital gains tax rate. Instead of paying high ordinary income tax rates, your capital gains tax rate could be 15%, 20%, or for many middle-income retirees, a beautiful 0%. If your total taxable income stays below certain thresholds, you can sell those appreciated investments and pay absolutely nothing in federal taxes on the growth. So, how do we take this information and turn it into a strategy that protects your wealth? Your actionable takeaway right now is to master the art of tax bracket management through strategic withdrawal sequencing. Do not just blindly pull money from one account until it is empty. You need to blend your income sources every single year to stay in the lowest possible tax bracket. In years where your income is naturally lower, perhaps right after you retire but before you start taking Social Security or mandatory distributions, you should seriously consider executing Roth conversions. This means intentionally moving money from your traditional pre-tax accounts into a Roth account, paying a small amount of tax now at a lower guaranteed bracket, so that money can grow and be withdrawn completely tax-free later when you need it most. You also need to understand your deductions. The standard deduction for seniors age 65 and older includes an additional higher amount on top of the regular standard deduction. Make sure you claim every single dollar you are entitled to, because every dollar of deduction is a dollar the IRS cannot touch. Your money must be protected, and the only person who is going to protect it is you. Take a hard look at your buckets today. Calculate what your provisional income will be. Do not let taxes ruin the retirement you spent a lifetime building. Stand in your truth, understand the rules, and keep your hard-earned money right where it belongs, in your hands.